In this presentation, I'm going to cover the mutual fund chapter in Mishkin Eakins textbook. Right now, it's in the 8th and 9th edition, chapter 20. I'm not sure it will be in future editions. So let's get started. For me to get started, I'm going to go ahead and turn off my webcam and just show you the presentation. So here we go. Okay, like I said, this is the mutual fund industry chapter on Mishkin and Eakins book entitled Financial Markets and Institutions. Eakins, not Easton. That in here. Okay, so we're going to start. If you have $100 to invest and you're young, like most of these students are, it's going to be really hard for you to open a brokerage account, although today it's possible. But historically, the only way you could do it with the $100 was mutual funds. Today, there are some brokerages that allow you to invest with $100 or less, but then you're going to have some of the problems that we're going to talk about later on. And one is denomination intermediation. That basically means a lot of these funds, a lot of stocks you can't buy with $100. In fact, right now, a good deal of the stocks in the NASDAQ, or some of the bigger stocks in the NASDAQ, the S&P 500, and the Dow costs more than $100 per share, so you couldn't even buy those stocks. For instance, if I want to buy Amazon, a share of Amazon today is $250,000. If I want to buy an investment company, Berkshire Hathaway, which is basically an investment company, is actually sort of a mutual fund in itself. But in that case, their shares $150,000. There's no way I could enter the market by and buy those shares if I wanted to invest in them, investing $100 or $100 a month. So we're going to talk about today our mutual funds. We're going to talk about the growth of mutual funds, the structure of mutual funds, objective classes, the fee structures of mutual funds, and this is really important for us as potential investors because it's important because fee structures actually affect our rate of return. Regulation of mutual funds, mainly by the SEC. A new type of mutual fund, when I say new in the last 20 years or so, is a hedge fund. And before the last financial crisis, hedge funds were, for the most part, unregulated. And finally, we're going to talk about conflicts of interest in the industry. Okay. So what does a mutual fund do? It pools the resources of a lot of small investors and sells them shares of a portfolio that it used of investors' money. So I take the money of a bunch of small investors to buy a portfolio, and then according to how much they gave me, I gave each investor a portion of that portfolio, usually by issuing them shares of that portfolio, of that mutual fund. So some facts about mutual funds. At the beginning of 2013, 50% of retirement assets were held by mutual funds. That means if you have a private retirement fund, more than likely, part of that fund is going to be in the form of some other mutual fund. If you invest in the stock market, for most people, most households, it's going to be with the use of mutual funds, either straight mutual funds, open-end mutual funds, or closed-end mutual funds. And specifically, one type of closed-end mutual fund today that's known as electronically traded funds, ETFs. So about 28% of the US stock market and almost 44% of US households are through mutual funds. So what that means is almost half of households in the US invest in mutual funds, one way or the other, either directly or indirectly, through a pension fund or a retirement account, or directly. The funds or the assets that mutual funds has grown really a lot, 17% per year over the last 24 years, and now is $14 trillion. To put that in perspective, that's about 2/3 of the GDP of the United States, of the annual GDP of the United States. Okay, some history of mutual funds. The first mutual fund was created in Boston in 1824. I think it's interesting that it was Boston and not New York, not near that street that had a wall next to it back then. But later on, that moved to the New York Stock Exchange, or mutual fund moved to the New York Stock Exchange. And it was growing steadily or slowly until the Great Depression, or the stock market crash of 1929. When that happened, small investors started to avoid mutual funds simply because they distrusted mutual funds. Before that, mutual fund managers, in order to gain business, sometimes outright lied about the risk of mutual funds had, and if not outright lied, weren't completely honest. Not all, but enough to have people distrust them. So in 1940, the government regulated mutual funds more vigorously in an attempt to make investing in mutual funds more transparent. That's the Investment Company Act of 1940. And basically, it required better disclosure of fees, what they're investing in, etc. In general, there were 5 benefits to investing in mutual funds. And this is pretty important, especially for our test. The first one is liquidity intermediation. What that means is I can quickly convert my investment into cash. And when I say quickly, it usually takes a few days. But once I ask for my cash for an open-end fund, or if I sell it with the close, or if I sell the fund in the secondary market, assuming it's a closed-end fund, I can usually get my money within a few days. The second is denomination intermediation. This is something we talked about at the beginning of the lecture. For instance, Amazon, now their shares are, a share of Amazon cost over $2,000 today. In addition, bond funds, to invest in treasury bonds, you need at least $10,000 to buy one bond. And in general, to open up a bond account, you need much more than that. But if I invest in a mutual fund, a bond fund, for instance, that I can do that with much less capital required. So basically, these mutual funds can buy a portfolio of these very expensive stocks, like Berkshire Hathaway. That's, if you remember at the beginning of the lecture, whose shares cost over $150,000. I can go ahead and buy Berkshire Hathaway without having to spend $150,000 by buying a mutual fund that invests part of its portfolio in Berkshire Hathaway. Number 3 is diversification. In general, the portfolios that mutual funds have are diversified. Some are not diversified, but in that case, an investor can buy different mutual funds. Right? For instance, I can buy the S&P Healthcare Index or the S&P Energy Index. I can buy those type of mutual funds, right, that invest in a certain industry or certain class of companies, and I can diversify in that way. And I can diversify differently than market. For instance, I don't like the distribution of different industries in the S&P 500. Well, I can buy different mutual funds and adjust that. In other words, I want to overweight one industry. For instance, I want to overweight technology. I can overweight technology and underweight other things, for instance, energy, or vice versa. So mutual funds offer the individual investor diversification, something that would be a little more difficult for them to do by themselves because they simply don't have the resources and funds to diversify properly. Number 4, they have a cost advantages. Mutual funds can negotiate lower transaction fees that would be available to individual investors. This advantage has kind of disappeared with time, but it's still there. And even today, when brokerages, and this is something fairly new, most brokerages now offer free trading. The reason they can offer free trading, however, is that they sell your orders to third parties. And those third parties make money between the bid and ask. They they manipulate the bid and ask electronically, and they can make tons of money off your, or they can make money off your trade. When I say ton of money off your trade, they don't make that much money off any individual trade. In fact, off an individual trade, they probably make pennies. But when those trades accumulate, they can obviously make a lot more money. Okay. So, but mutual funds don't have to negotiate with those people. They can buy stock directly because they're bigger. So even though it's not a cost advantage, it does give them a slightly better price than an individual investor could get on stocks. And finally, managerial expertise. Mutual fund managers have gone to school. Hopefully they have some experience in investing, and therefore they might be able to offer you better returns, at least before fees. We'll talk about that later on in the lecture. Okay, now I want to talk about the growth of mutual funds. In 1980, only about 6% of households in the United States own mutual funds. A lot more were invested in the stock market or bond market, but not through mutual funds. About 40 some odd years later, it's 33 years later, 44% of households own mutual funds, with 75% of funds being owned by households. In other words, only 25% of mutual funds are owned by individual investors. And even though only 44% of households own stocks, those households own 75% of the funds out there. I hope that makes sense. In other words, 44% of households have stocks, but those 44% own 75% of the mutual funds out there. Right now, mutual funds account for $5.3 trillion of the retirement market, which is in total estimated to be right around our annual GDP in the United States. Okay. Here I have a table from 1970 to 79, and we're going to go by decade. And we'll see how assets have grown since the 70s the number of mutual fund accounts and the number of funds that exist out there, we can see that they grew probably about 50% in the decade of the 70s, and doubled in the amount of assets they have. But the number of accounts decreased slightly. In the 80s, well, the assets grew almost ninefold. The number of funds quadrupled, actually more than quadrupled, increased about 500%. And the number of accounts grew by about 400%. Now, in the 90s, the assets grew about 600%. The number of funds more than doubled. And the number of accounts grew about 300%, from 62,000 to 226,000. From 2000 to 2010, the number of assets almost doubled, or the amount of assets almost doubled, but the number of funds increased and then decreased, basically staying the same in this time. The number of accounts increased up into about 2007 and then decreased. Now, this is the recession of 2007, 2009, which was initiated by our latest financial crisis, and that's why both assets, the number of funds, right, basically stayed steady, and the number of accounts decreased during that time. Now, after the financial crisis, the number of accounts basically decreased. It turned around about 2014, and the assets they had actually increased. And that makes sense because after 2009, the stock market finally rebounded and started going up, and a lot of these funds are equity funds. In other words, funds that invest in the stock market, but the number of funds out there remain more or less constant. Okay. Here we see a graph of the number of households that own mutual funds. Here was our graph of 5.7 in 1980 and increased up into 2000. That reached almost 50%, and in 2013, 2014 decreased to 44%. But since 2000 has remained more or less steady, with ups and downs of the number of households that own mutual funds. Okay, here we see the distribution of mutual funds of two different groups. The first one being people in their 20s. These are young professionals in general who graduated from college, maybe not, but are starting to invest in mutual funds. And we can see that they invest in equity funds and what's called target date funds. Now, these target date funds can be hybrid funds or equity funds, but what they try to do is they have a date in which they expect their profits to be maximized from here to that date. So basically, it might be that this fund right now is going to invest heavily in growth companies, in companies that have a lot of growth right now, but may not pay a lot of dividends or have good financial ratios, but are growing fast. With the intent that as time goes on, I'm going to switch from those growth companies, or those growth companies probably will decrease their growth. But in any case, my portfolio is going to switch one way or another, either me actively changing or those companies that I invest in changing from high growth companies to more secure companies with more steady earnings in the future. So basically, if I have a target date of, let's say, 2040. I might invest a lot of growth companies now with a plan in the future to switch from those growth companies, either because the growth companies start growing a little more slowly, but provide income, or I sell those growth companies and buy other companies that'll provide my shareholders with more income. And that makes sense for somebody in their 20s. It makes less sense for somebody in their 60s. So that's why target date funds aren't as popular with people in their 60s. Equity funds, which is actually something that surprises me, that more people in their 60s own equity funds than people in their 20s. However, that's probably because most of these target date funds are also equity funds. So that decreased. They have more balanced funds than than people in their 20s. They have about double the bond funds of people in their 20s, which makes sense. They want to secure their income, where people in their 20s are looking for more capital accumulation. Money market funds, again, they want their money, they want liquidity, where people in their 20s probably don't care that much about liquidity, but they want growth. Stable value funds and GIC, these are the government investment companies. Yes. Anyway, stable value, again, 10% for people in their 60s, 2% for people in their 20s. People in their 60s want that stable income, where people in their 20s want growth. Company stock. Now, this is pretty much, there's not much of a difference. Again, it's not, I'm sorry, it might be a little surprising, but it might be that both these people have stocks that they really like and they really believe in, so it's not that surprising. And then other investments are about 6%. But the important thing is that equity funds and these target date funds, or that combination, right, are going to be much greater for people in their 20s than people in their 60s, because they're looking for that growth, and they have a long time before they're going to be using these investments. In other words, these investments are probably for either college funds or retirement funds. When these guys probably already put their children to college, and if they did, and are looking to retire soon, and they want their income to be secure. So they're less into equity and target date funds and more into bond funds and such, and funds that'll give them a more steady stream of income with less risk. Okay, the structure of mutual funds. Investment companies usually offer a number of types of mutual funds. For instance, Fidelity, Janus, God, how come I can't think of any? But there's Vanguard. All of these companies basically have a bunch of different types of mutual funds, and they hire different mutual fund managers. They might have a value fund, an equity growth fund, all kinds of different funds with different objectives. And within a company, or within an investment company, investors can usually move investments along these funds. So, for instance, I can move from a target date fund to an equity fund to a bond fund. As long as I'm in Vanguard, for instance, I can move from one type of fund to the other with a small fee, and I don't have any penalties for taking it out. And basically, they're not going to charge me extra fees like I would if I took my money out of Vanguard and, let's say, invested with Janus or another mutual fund. In that case, I'd have a small fees from taking my money out and then fees from reinvesting. If I invest within these investment companies, those extra fees aren't charged. A lot of these companies have very complex organizations. partly because of the law. And in general, if I have 2 or 3 funds in the same fund family or with the investment company, then I'll get a statement with all 3 funds in once. And it can be sometimes a little confusing. The other structure between funds are closed-end funds and open-end funds. There's a lot more open-end funds than there are closed-end funds, at least historically there have been. Today, with electronically traded funds, which are a form of closed-end funds, I think that number is changing slightly because investors seem to have a preference for these electronically traded funds. But a closed-end fund is the following. It's a fixed number of non-redeemable shares that are sold through an initial public offering and then traded on a secondary market, a secondary over-the-counter market, OTC market. The price of the shares is determined by supply and demand forces. Now, what does that mean? First of all, they're non-redeemable. In other words, if I buy a fund, a closed-end fund, even if I buy it when they issue, I can't go to the fund and say, here, give me my money. So part of the contract is this closed. I have to hold the fund until it matures. Now, that doesn't mean I can't sell the fund. I can sell it to somebody else on the secondary market. And the secondary market is an over-the-counter market. And those price of those shares, the price that I can get for that closed-end fund is going to be determined by supply and demand. What that means is that the price of the share that I'm selling can be different from the value of the closed-end fund. And we measure value in net asset value, NAV, net asset value. And the net asset value per share of a closed-end fund can therefore be different than, can therefore be different than the price that that closed-end fund is selling. For an open-end fund, well, in this case, the investor in general can't sell it in the secondary market, but I can go ahead and redeem my shares with the fund at any time I want for their NAV, their net asset value. That's an open-end fund. I invest directly with the fund and I get my money from that fund. Closed-end fund, I invest in the fund either directly in the primary offering or in the secondary market. And if I want to get my money before that fund matures, I have to sell it on the secondary market to somebody else. And the price I get can be above or below the net asset value. So here's our definition of the net asset value. The total value of a mutual fund stock, bonds, cash, or other assets minus liabilities, such as accrued fees, divided by the number of shares outstanding. So basically, if I take all the assets, right, if I take all of the assets of a fund and I divide it by the number of shares, I get the net asset value per share. Now your book, or at least in here, doesn't make that distinction. So I'm not really gonna worry about it too much for a test. So here, if we talk about net asset value on a test, you can either define it as the total assets that the fund has, or the total, or the total assets the fund has divided by the number of shares outstanding. So that's our NAV, net asset value. Here we have a mutual fund. It's a hybrid fund because it invests in both stocks and bonds. It has $20 million in stocks, $10 million in bonds, and $500,000 in cash. For total assets of $30,500,000, and liabilities, basically the fees and charges, are $300,000. So that means its net worth, or what most people would call its net asset value, is $30,200,000. It has 10 million shares outstanding, so I divide this number by 10 million, and I get the net asset value per share, or for us, for book purposes, net asset value. That's 30,200,000 divided by 10 million, or $3 per share. I can buy this stock for $3 per share. So if I wanted to buy 100 shares, it would cost me $302. Okay. Now let's talk about the organization of mutual funds. The shareholders are essentially the owners of that portfolio, who are also the investors in that portfolio. Bonds have a board of directors, in Spanish, junta, that oversees the fund activities. It hires the investment advisor, it hires the underwriters, it hires basically everybody who's supposed to manage that fund and manage the day-to-day operations of that fund. So in general, what you have are the people that own the fund, the shareholders. You have the mutual fund, the board of directors, and the board of directors basically is in charge of hiring the investment advisor. Now, the investment advisor can be whatever company. It can be, the example I gave, Vanguard, it could be Fidelity, etc. It hires their underwriters. Basically, these are the people that do all the legal stuff and do all the processing to get those shares to the shareholders, to get money from them, make sure they have the portfolio, and issue those shares to the stockholders. They do all that's necessary to do that, including all the legal and SEC stuff. The administrator that oversees the performance of the other companies that provide services to the fund and ensures that the funds comply with applicable federal requirements. We have transfer agents. These are executive shareholder transactions, execute shareholder transactions, maintains records of the transaction and other shareholder account activity, and sends account statements and other documents to the shareholder. These are the guys that send you your statement. The custodian holds the fund's assets, maintaining them separately to protect shareholder interests and reconciling the fund's holdings against the custodian's records. In other words, these are the guys that try to ensure that the fund manager isn't going to embezzle the money. And finally, an independent CPA, an independent certified public accountant that's hired by the board of directors. Now, the thing is that the board of directors, in general, most of its members are going to be independent members. In other words, they don't work for the mutual fund, but they hire all these people that do. So, in theory, I like the way your book does this. A board can fire the fund manager and hire anybody they choose. For instance, the board can hire Fidelity Magellan Fund. The board for Fidelity Magellan Fund could fire Fidelity. But if they fired Fidelity, then it would no longer be a Fidelity mutual fund. So therefore, it would have to change its name, it'd have to change its advertising, etc. So that usually doesn't happen. Usually, if there's a problem, the fund just liquidates and gives the money back to the shareholders. But even that is really rare. Objective classes. In general, there are 4 types of mutual funds. There's stock funds, there's bond funds, there's hybrid funds, and hybrid funds are usually a mixture of these two, and sometimes a mixture even of money market funds. But in general, money market funds are a lot more liquid. So in general, if you want to invest in a money market fund, it's because you want access to your cash. So those are the 4 general objective classes. Here we have a graph. We can see the majority is stock funds, 8 trillion. Bond funds are 3.4 trillion, money market funds are 18 trillion, and hybrid funds are 8%. So over half of these funds are stock funds, equity. And that's what we're going to talk about, stock funds. So other than investing in stock, common equity, they usually have a stated objective of a particular fund, and that can vary dramatically from fund to fund. It can also give the manager some leeway into how they invest. In other words, if you start off as, let's say, a growth fund, depending on your objective statement, you might be able to switch into being a value fund. Now, those growth funds sometimes are called or capital appreciation funds. They seek rapid increase in the share price, and they don't care that much about dividends. What they want are stocks that are going to increase in price, whether they're earning money right now or not. They're growing fast, and their price should increase. Total return funds seek a balance between current income and capital appreciation. In other words, they have those stocks that are growing fast and those stocks that are paying dividends, i.e., giving them income. So they have a balance. Those are total return funds. World equity funds, basically, these are funds that invest in foreign stock markets or foreign bond markets. We're talking about stocks, so this is foreign stock market. Other type of funds are value funds. These are funds whose financial statements or financial ratios are good relative to the industry, but their price, right, is below industry standards or below what other companies with those same financial ratios and growth prospects have. So, in other words, these value funds, you expect with time, will catch up to other similar companies with the same financial ratios, and therefore give you a return. Growth funds, well, growth funds are basically capital accumulation funds. These are funds that you expect to grow, company to grow, both in revenue and profits quickly in the industry, and therefore you expect the price of those funds to increase, or those stocks to increase. There's also funds that invest in particular industries. For instance, the energy industry, textiles, utilities, etc. Pick an industry, there's probably a mutual fund that you can invest in that'll help you invest in most of the companies in the industry. The next type of funds are bond funds. And these are, you can divide into a few. First, strategic income funds. Invest primarily in U.S. corporate bonds, and U.S. corporate bonds in general pay a higher interest rate than other types than government bonds because they're riskier. Therefore, will give you a higher rate of return in general. Government bond funds that invest in U.S. treasuries and possibly municipal bonds, state and local bonds, we talked about earlier. And you can have a combination of the two, or just one or the other. One that only invests in mutual funds and not U.S. treasuries, or one that invests in U.S. treasuries and not municipal bonds. There's other bonds, world bond funds. These are bond funds that invest in international bonds, bonds issued in other countries, either by companies or by government. So here we have a breakdown of different funds. There are funds that invest in investment grade corporate. Remember, for us, these are triple B or BBA and above. BBA or below BBA are high yield funds, and there are high yield funds. They don't like to be called junk bond funds, but a lot of people call them junk bond funds. World funds or international funds invest in foreign companies and bonds, either foreign government bonds or foreign corporate bonds. That's 13% of the bond market, or 431 billion. Government bonds, in general, these are federal government bonds, 8%. Multi-sector that has both muni, state, and national municipal bonds. State municipal bonds that invest in the bonds of certain states. For instance, you can invest only in Puerto Rican bond funds through a mutual fund, or you can invest for a wide variety of municipal bonds that might hold bonds in different states. Now, the advantage to the state bond funds investing in one bond or one state or another, is that not all states give tax breaks to other states' bond funds. For instance, the federal government, it's been determined by precedents that the federal government can't tax the income that state bond funds can give you. But if I invest, for instance, if I live in Florida and I invest in Puerto Rican bond funds, Florida can either decide to tax that money I'm getting from my Puerto Rican bond fund or not. And that depends on the state. For Puerto Rico's lucky. Almost no state taxes the income, so it's before a financial crisis, it was a very attractive investment because it was going to be, excuse me, it was going to be tax-free at both the state level and the local level, and at the city level, if, for instance, if you lived in New York City. So that way I can pick for a state bond fund, I can pick only those states or bonds of those states which my state, the state I live in, doesn't charge taxes on the interest I receive. And national municipal bond funds, again, they invest in a bunch of states and cities municipal bonds. Hybrid bond funds. Now, hybrid bond funds can invest in both stocks and bonds, and they do it into a single fund. But they only account for 5% of all mutual funds. That's because most people think that the individual investor can do this better than a bond fund can. In other words, they can decide how much of their money they want invested in stocks, how much in bonds, by simply adjusting their portfolio, investing, say, 60% in stock funds, 40% in bond funds. But if you don't want to worry about that, you can buy a hybrid fund. The fourth objective class is money market mutual funds. Remember, a money market mutual fund is a lot like a checking account because the assets they invest in are, in general, very liquid. And because of that, they offer check writing privileges. And of course, the amount of checks written in the United States has decreased. So instead of checks, they also offer, or in place of checks, they offer debit cards. So if you go to a supermarket, you don't have to write a check anymore. You pay with your debit card. And you can do that with mutual funds. With money market mutual funds. And these guys, their assets have grown quite a bit over recent years, mainly because of technology. So if we look here, starting in the 90s, right, their net assets were less than $100 million. And they were even lower in the 80s. But with time, these money market mutual funds started to grow. And part of that was, one was technology. Number two was basically deregulation. It allowed these guys to basically, or take people's money and be able to return their money in very short notice. In other words, these money market mutual funds are very liquid. I can get my money quickly. In This area, this time, a lot of money market mutual funds started to invest in uh, mortgage-backed securities. In other words, they were mortgage-backed securities, or these investors started issuing commercial paper. And it really grew right in this time between 2008 and 2006 and 2008. This is where a ton of companies started selling commercial paper backed by mortgage-backed securities, and that created a problem. And after that, the mutual fund or the growth in money market mutual funds uh, basically stopped. It did start growing here after 2016. Again, it didn't get as high as it did in 2008. Money market mutual funds, uh, in general, offer higher returns than banks. And this is especially true back in the 80s, before that graph shows, because banks back in the 80s, up until the 80s, were restricted in how much interest they can pay. The problem with money market mutual fund relative to bank is that they are not FDIC insured. Uh, but in general, they invest in liquid assets. Now, if you want a money market mutual fund that is just as safe as a bank account, you can look for money market mutual funds that invest or have a larger percentage of their assets in treasury bills. Again, treasury bills are insured by the government, just like the FDIC. So here we talk about the distribution of assets in money market mutual funds, right? T-bills we see are 17.2%. Other U.S. securities, these are in general short-term muni bonds, and more importantly, short-term bonds issued by Ginnie Mae and Freddie Mac, Sallie Mae. All of these quasi-private companies that were created by the U.S. government, basically commercial paper, U.S. agency issues, treasuries, etc. I'm sorry, not treasury. These are the treasuries. And repurchase agreements. I had somebody argue that it was the treasury that held most of, or was the most important player. But in general, U.S. Treasury agencies, they don't issue in the money market. In fact, these are bonds that were issued a while back with longer maturities, and they're basically just coming due. T-bills are issued just once, and the Treasury Department doesn't buy secondary bonds. All of this in here, right? All of this, the biggest players are the Federal Reserve. They buy and sell repos, repurchase agreements. They buy and sell T-bills, and they buy and sell U.S. agencies with very, with very low time to maturity. So it's the Federal Reserve. Index funds. Index funds are basically funds that mimic an index. The most quoted index is the Dow Jones Industrial Average, sometimes known as the Dow. Don't type in Dow to a sickle symbol because it'll give you Dow Chemical. But the Dow, or the Dow Jones Industrial Average, is a weighted average of 30 large stocks in the U.S. economy. And it's basically gives us an idea of how large stocks are doing in the economy. Another one is the Standard & Poor's 500 index. These are supposed to be the 500 most influential stocks or biggest stocks in the country. Of course, obviously the number or stocks that go into the S&P fund change every year. In other words, some stocks enter, some stocks leave. The same thing is with the Dow. For instance, 5 years ago, General Electric was in the Dow. It's no longer in the Dow. The other index fund, the other big index fund, is the NASDAQ. And this is an index of 100 firms that trade on the NASDAQ stock exchange, who are in general technology companies, but not necessarily. For instance, Pepsi trades on the NASDAQ. In fact, it's one of its top 10 biggest holdings in the NASDAQ is Pepsi. I mean, the big holdings are obviously Apple, Amazon, Google, Microsoft. But Pepsi's right below those companies, and it's not a technology company, so it's not all technology companies, even though it's pretty overweighted with technology companies. So all of these are indices, and all of these have, excuse me, all of these have mutual funds that track them. They basically buy the stocks in them, or they buy stocks that'll mimic how these indices will change. In addition, inside the S&P, you can take those 500 companies and break them up into different industries. And there's a lot of mutual fund companies that do this. Standard & Poor's does this, and out of their indices, they have a transportation index, they have an industrial index, they have a technology index. Basically, they have 11 or I can't remember if it's 11 or 12. They have 11 or 12 sub-indexes of the S&P 500, and there are mutual funds that track those sub-indices in the S&P 500. Okay. Now, this is one of the important things for investors in mutual funds. And these are basically the structure, the fee structures they have. Load funds, these are Class A shares. They charge you a fee up front. No load funds do not charge this fee. And in general, it's been showing that these are the type of funds people should invest in. In general, those index funds that we talked about a while ago are no load funds. Deferred load funds, these are Class B funds. These are funds that don't charge you a fee up front, but they charge you a fee after you redeem your shares. In other words, after you ask for your money back. Now, these have an advantage over these Class A shares in that when I invest, right, for instance, let's say the load was 3% and I had $100,000. Well, basically, when I start investing, I have $97,000 instead of $100,000. So if my returns are compounding, I'd rather compound off $100,000 than off $97,000. So the deferred load fees do have an advantage over the load funds because I'm able to accumulate more over time. And of course, if I don't accumulate, well, then, for instance, I had $100,000, I had to pay 3%, I only have $97,000, I lose money. Well, then in that case, it'll be really bad. But if I have a deferred load fund, if I lose money, I'm only paying 3% of $90,000 instead of 3% of $100,000, or I would be in a load fund. So they're especially good if I lose money, but they're also good if if I make money. But again, the best type are these Class C shares, right? These are no load funds that don't have a front or a back end fee. These are the type of funds in general investors should look for. Now, in general, active fund managers, those fund managers that aren't investing in an index or don't manage an index fund, that try to pick stocks Well, they have higher fees. But the majority of research in mutual funds show that Class C shares in general outperform Class A and B shares, uh, at least after, excuse me, at least after fees are charged. In other words, it's rare for an active fund manager to actually earn his money. In other words, to make you more money or to make more money over what index funds would make you, uh, given how much they pay in fees. In other words, their fees, right, make their total return lower than index funds. Okay. So our fee structures, other fees charged by mutual funds include contingent deferred sales charge. This is a back-end fee that might disappear altogether if I hold the fund long enough. Redemption fees, uh, just another name for back-end load fees. Exchange fees, this is a fee, usually pretty low, for transferring money between funds. In other words, if I have a Vanguard growth fund and I transfer it to a Vanguard value fund, they're going to charge me a small fee switching from one to the other. But in general, again, it's usually very small, especially compared to if I want to take my money out. Account maintenance fees, basically these are basically fees when you let your balance get too low. And 12B1 fees, these are fees that are a lot of times hidden in these statements. These are fees to pay for marketing, advertising, commission. Again, aside from paying attention to the load that we talked about in the previous, excuse me, in the previous slide, right? Pay attention to the loads. Also pay attention to 12B1 fees. Because they'll take out part of your return also. Mutual funds in general are regulated by 4 laws. Usually, almost all of them were created after the Great Depression. The Security Act of 1933 specifies what they have to tell you. Security Exchange Act basically outlines fraud. Outlines fraud. It's always been illegal. The Investment Company Act of 1940 requires registration and minimum operating standards, and they regulate, or the Investment Advisors Act of 1940 regulates what fund advisors can do and what they can't do. So basically, all of this was to try to create transparency within the mutual fund industry, and therefore try to assure investors that these mutual funds were safe to invest in. In general, mutual funds are the only company in the US required by law to have independent directors, right? So these independent directors, as we talked about, must constitute a majority of the board. In other words, they have to have over 50% of the board that are independent directors. When a new independent director comes in, when one gets fired or one leaves the board and a new one comes in, the people who appoint that independent director are the other independent directors. In other words, it can't be those guys that work for the mutual fund company. The lawyers that they hire and the accounting companies have to be independent too. Now your book talks about a mutual fund known as long-term capital management. Now this company is interesting because it was created by some academics. Now, this was basically a hedge fund, or what's called a hedge fund. And like I said, historically, hedge funds were largely unregulated. We're going to talk about hedge funds. In general, hedge funds, they require a huge capital investment, at least $1 million. I shouldn't say at least $1 million. On average, about $1 million. A long-term commitment is required. In other words, I put my money in, and the fund manager gets to keep that money and invest it for me for a specific amount of time. And in that time, I can't take my money out. In general, they charge really high fees. Your book claims that they charge 1% of their assets plus 20% of profits. If you're going to charge those high fees, well, you better make a good return. In general, they're highly levered. So basically what they do is they take a bunch of assets from the investors, and then they borrow a bunch of money and basically invest on margin. And like I said before, the 2007, 2009 financial crisis, there was almost no regulation of hedge funds. Today, there's a little more. Your book argues that there's still not anywhere near enough. And of course, it's not regulated like other mutual funds are. So hedge funds in general are trying to take advantage of the spread between security prices, but not always. Some hedge funds invest in weird things, some in future markets, some in bond markets, some in stock markets, some in non-traded markets like art, some in real estate. And as the name suggests, at first this was supposed to be a hedge against stock prices because it was supposed to be unrelated to stock prices. But that's changed. But anyhow, it doesn't necessarily have to be a hedge. But in general, it's different than any mutual fund invests in. For instance, this long-term capital management, right? They saw that the difference between treasury bonds with the maturity date of 29 and a half years were relatively cheap to those of 30 years. So they figured that with time they'd converge. They bought $2 billion, billion with a B, of 29 and a half year bonds and sold short $2 billion of 30-year bonds. 6 months later, they reversed the positions, they reversed their transactions, and they realized $25 million profit. Now, 25 million seems like a lot, but when you consider how much capital you put in, basically you're risking $4 billion, and to make $25 million isn't a heck of a whole lot. So that was basically, here, let's do the math. Oops. Looked at $4 million because it was 4 long, 4 short. And this is what they made. Which is roughly 6% of what they invested. Of course, 6% ain't bad for 6 months, but it's not great either. Especially you consider the assets, the assets invested or the amount invested. So here it is. I have A, which in this case would be the 25 and a half year bonds, and B, the 30-year bonds, and we'll see how they diverged. And of course, in this case, I short these, I buy these, and I'm sorry, these are the 25.5-year bonds. This is 30. So basically, I buy these, I short these, and hopefully they come together again and I make money, which happened. Now, this fund was run by a guy named John Merriweather, but its board, right, included Myron Scholes. For those of you in finance, if you take an options class, the way options are priced today, in general, is through something known as the Black-Scholes formula. Myron Scholes is the Scholes of that. They came up with this formula to price options. And people use that formula still today. Martin's another prize winner that basically helped in developing the capital asset pricing model, which is also very important in finance. So making trades like we saw a while ago, like the example we saw a while ago between the 29.5-year bond and the 30-year bond, right? They made really good returns, 30% for basically the first few years that they operated. But eventually it caught up with them when they made bets that lost them money. And remember, this was a highly levered company. In other words, they were borrowing money to invest. And when you borrow money, if you make a huge investment, well, that's good. Basically, you pay back the money you borrow, you pay back the interest, which is, in general, just a small fraction of the profits you made. So you get to keep that difference on top of what you invested of your own money. And that's why buying on margin can make you a lot of money, but it's also very risky. Now, when these guys started losing money, as your book says, the collapse was imminent. And this hedge fund basically got rescued by regulators. It got rescued by the federal government. It had $80 billion in equity positions in stocks and over $1 trillion in derivative positions. That means options and futures, mainly futures. And if it lost that, the futures market would have been devastated. And that would have hurt the US economy. So the government the government rescued them because at that point they were too big to fail, which was one of the criticisms that we didn't fix that after the last financial crisis. We still have a bunch of these hedge funds that are huge and essentially too big to fail. And the government would have to rescue them in the next financial crisis. And we are. So we have a bunch of hedge funds that failed since long-term capital management. Amaranthus, I'm sure I'm pronouncing that wrong, advisors, they lost $6 million in natural gas futures in 1 week. Other funds also lost. So hedge funds basically are speculators. The book of Gamblers, speculators, same thing. They take a lot of risk. And when things are going good, they make a lot of money. But when things are going bad, they lose a lot of money. So in 2006, the SEC passed regulations require hedge funds, right, to register with the SEC, basically because they were worried about fraud. Since smaller investors, all of those of us without $1 million, can now invest in hedge funds, but it still requires quite a bit of money. $100,000 $10,000 to invest in these hedge funds. Like I said, it doesn't require $1 million anymore, but you still need more than most of us have to invest in these hedge funds. Again, some offer high returns, but they're risky. The next thing I want to talk about are conflicts of interest in the mutual fund industry. It's very important that investors are confident that the mutual fund industry is stable and that it's fraud-free and it has integrity. That doesn't mean that you're going to guarantee that these investors don't lose money. They can lose money. But in general, we want to make sure that the mutual fund industry is stable and that mutual fund advisors are honest. But we still have the problem of asymmetric information. Remember, asymmetric means uneven. And our principal agent problem that leads to cheating, fraud, abuses by fund managers. And we're going to talk about some of the abuses. One of them is late trading. Now, remember, the United States is a pretty big country. They have 4 different time zones. They have Eastern, they have Central, Mountain, and Pacific. Now, if you count Puerto Rico and Hawaii, that's 6. Hawaii, Alaska, that's 6 different time zones. But in general, the continental United States has 4 different time zones. So when markets close in New York on the East Coast at 4 p.m., it's still 1 p.m. in California. So that creates what we call a market timing problem. Actually, let me talk about the late trading. Late trading basically says that after 4 p.m., no matter where you're at, that you can't trade anymore. But some mutual funds allow some of their best customers to do just that, to trade after 4 p.m. For instance, at 4 p.m., you saw news that something that's going to affect your mutual fund in an adverse way. Well, I would really love not to have to wait till the next day to trade and sell my shares today. Or if it's something positive, I'd love to buy my shares at today's closing price instead of waiting till tomorrow's opening price. In both those cases, that is illegal. But a lot of fund managers allow their best clients to do it. The other is market timing. Again, taking advantage of time zones. Me living in California at 1 p.m. when markets close on the East Coast, I go ahead and trade for 3 extra hours. Now, in general, this isn't illegal, but whether it's ethical or not is subjective. And here are some examples. Alliance Capital Management Corporation allowed their traders to engage in market timing, and they ended up paying $450 million in fines. Again, right? Market timing in general is not illegal, but the SEC was still able to fine these people for doing it. Bank of America and Canary Capital Partners, I've never heard of them before this, maybe you have, agreed to reduce their funds to their stockholders by $160 million and pay fines and restitutions of $375 million. Again, for market timing, which is not illegal, but the SEC was basically telling them that they couldn't do it anymore, and especially they couldn't do it if they were only offering it to certain clients and not all clients. Here we go. Janus reduced fees by $125 million and paid fines of $100 million. Putnam Investment, Putnam is the 5th largest fund managers, and they agreed to pay $100 million in fines and restitution to stockholders, shareholders. Now, I find this interesting. The SEC did a survey of fund advisors, fund managers. Basically, the 88 biggest mutual fund companies. And they said that they found in the survey that 25% of these broker dealers were allowed to make illegal late trades. Now, this was a survey, and these people are admitting they're breaking the law. Now, it's possible that these broker dealers somehow don't know that they're breaking the law. They're supposed to pass a bunch of tests, but that's possible. But more than likely, they're admitting to breaking the law because they don't think there's any consequences. And if 25% are admitting to breaking the law, my guess is there's a lot more that aren't, let's not call them dumb enough, but aren't willing to admit to breaking the law. Half the funds, that means 50%, allow some privileged shareholders to engage in market timing trades. In other words, they're allowing some shareholders to do it and not all. So if I lived on the West Coast at 1 p.m. and I see something happening on the East Coast, I can make trades between 1 and 4. That's going to allow me to take advantage of that news that people on the East Coast can't, and other shareholders can't. Research shows all that more than 30% of funds admitted that their managers have shared sensitive portfolio information with favored shareholders. In other words, I'm giving certain shareholders information about the portfolio that I'm not giving everybody, that I'm not making public. I'm just lying. Again, that's insider trading. That is illegal. This is a survey, and these people are admitting that they're breaking the law, which is something, if you would have asked me before this survey, before I read about the survey, I would guess that almost none of them would admit that what they're doing would admit what they're doing because it's illegal. But they did. So what did the government do? Well, number one, it required more independent directors. It hardened that 4 o'clock valuation rule, and it tried to address the late trading problem, that market, but not market timing. In other words, they see it as unfair that people on the West Coast have to stop trading at 1 p.m., even though it's 4 p.m. on the East Coast. And of course, if you wake up when the market opens on the East Coast at, excuse me, at 9 a.m., it's 6 a.m. in California. So that's kind of early to wake up. Increased enforcement and redemption fees to discourage market timing, and additional fees for short-term redemptions. In other words, if they're going to do this illegal stuff, the chances that they're going to make a profit doing that illegal stuff gets decreased, because to do that illegal, especially short-term redemptions, buying and selling one day to the other, you're going to have additional fees. And finally, increased transparency. Basically, their operating practices, what they share with investors, the directors, the investment managers, how much compensation these guys get with their brokers for their big, better customers and their smaller customers. Okay, well, that's the end of the lecture. What we talked about the growth in the mutual fund industry. We talked about how it went from 300 billion in 1980 to over 14 trillion in 2012. How 44% of U.S. households own mutual funds. We talked about the mutual fund structure, the organization, the ownership, the boards, independent directors, and the operation of the funds. We talked about different objective classes, like capital accumulation or growth. We talked about the difference between equity, debt, and hybrid funds and money market funds. We talked about fee structures of investment funds and the various fees charged by funds. We defined them and reviewed them. Again, the advice that the academic world gives is find the lowest, find the funds with the lowest fees. Because in general, fund managers, active fund managers, aren't worth the extra money you pay them. We talked about the regulation of the mutual fund industry. We talked about the acts and the laws. We talked about hedge funds and how they were different from regular mutual funds, the purpose, the definition, and how these funds are in general riskier than regular mutual funds. And finally, we talked about the conflict of interest and basically timing in the mutual fund industry and how that was illegal and unethical, and how some fund managers have been fined, and a survey that shows that a lot of these mutual funds engage in these illegal activities. That's it. This will be on the third midterm exam, or the material will be on the third midterm exam. You can also see the spreadsheet on the class webpage at jtorres.uprrp.edu. Go there, click on the class link. That'll put you in our, that'll put you on our syllabus. And at the bottom, the last lecture will be this lecture, mutual fund. You can see it in PDF format. Okay, well, I guess that's it. Good luck on the tests, and thank you.